Good afternoon. I'm Claudia Kramer, Probasco Distinguished Chair for Free Enterprise and Professor of Economics here at University of Tennessee at Chattanooga. It is my great pleasure to welcome you to the annual Financial Literacy Lecture Series. This series is co-hosted by the Probasco Chair, the Center for Economic Education, and the Department of Finance and Economics in the Gary W. Rollins College of Business at UTC. April is Financial Literacy Month. Financial literacy leads to financial wellness. Financial well-being comes from the ability to absorb financial shocks and control day-to-day and month-to-month finances. It comes from being able to meet your financial goals and having the financial freedom to make the choices that allow you to enjoy your life. Financial literacy starts with public awareness. Today's lecture will shine a spotlight on the need for financial literacy in America and elsewhere. Before getting into our talk today, I am pleased to report that more students are choosing to take charge of their financial wellness by enrolling in personal finance minor in the courses that we're offering here at UTC. A few housekeeping notes. So we urge all participants to submit questions and comments in the Zoom chat. Furthermore, if you're a UTC student and you've been incentivized to attend today's lecture, please drop your name and your UTC ID in the chat so we can keep track. Now I'd like to briefly turn it over to Mr. Bill Parker, who is Director of the Tennessee Financial Literacy Commission.
Thank you, Dr. Kramer. Hi, everyone. It's a great privilege to be here with you today to help tee up this year's financial literacy lecture on a topic that influences every aspect of our lives, financial literacy. At the Tennessee Financial Literacy Commission, we believe financial education is more than just a classroom subject. It's a critical component in your foundation for lifelong success. It's an essential skill, one that directly affects our health, your relationships, your career choices, and your overall happiness. Similarly, this isn't just another lecture. Consider it a right place at the right time opportunity that could be the light bulb moment that completely reshapes your approach to long-term happiness and success. Here's the reality. Money touches everything. When people lack financial knowledge or face financial instability, it doesn't just stay in their bank account. It spills over into stress levels, sleep patterns, decisions around family planning, relationships, careers, and I can't emphasize this enough, our overall mental and physical health. Studies have shown that financial stress is one of the leading causes of anxiety, depression, and divorce. It forces people to make choices they wouldn't otherwise make, like delaying medical care, putting off starting a family, or feeling trapped in situations they want to leave, whether that's a job, a relationship, or even where they live. And ultimately, these struggles often don't end with one person. The quote unquote psychology of money can impact families for generations. And that's why Tennessee is taking a full court press approach to financial education, ensuring that students don't just encounter financial literacy once, but early and often throughout their education. Under the leadership of State Treasurer David Lillard, who also serves as the chair of our board, we're working to embed financial knowledge into classrooms across the state, from elementary school through high school, so that young people enter adulthood with the tools to make informed financial choices before they face major life decisions. But even for those of us well beyond high school, financial literacy is never a finished lesson. If you were fully financially literate yesterday, chances are a new investment product, a new technology, or a new scam has surfaced overnight. The financial world is evolving constantly, and a commitment to lifelong learning is the only way to keep up. And here's why this work matters beyond just individual success. Because when one person gains financial knowledge, the impact snowballs. Parents pass it down to their children, friends inspire others to make subtle, even 1% improvements that have lasting impact, and communities become stronger when people are able to manage money effectively, avoid financial traps, and build wealth for the future. That's how we break cycles of financial struggle and create lasting change across generations. So today, as we learn more about these critical issues, I encourage you to think about your own financial journey, not just where you are, but where you want to go. Because understanding money isn't just about earning a paycheck and paying the bills. It's about learning to use it as a tool to build the life you want. Now, for the sake of your future self, future generations, your community, our state, and our nation, thank you for your commitment to lifelong learning in the area of financial wellness.
Thank you, Mr. Parker. And now it is time to turn to our keynote on coping with complexity. And thank you and welcome to Professor Terry Odean at UC Berkeley.
Thank you. I'm happy to be here. So, coping with the complexity. When I was growing up in the 1950s in White Bear Lake, Minnesota, that's me on the left with my mouth wide open, nobody took financial literacy courses. There were plenty of people who struggled financially. However, the decisions they faced were much simpler than the decisions facing consumers today. Let me give you a couple of examples. My parents did not have credit card debt. In fact, nobody in White Bear Lake had credit card debt. Might seem miraculous, but nobody had a credit card. So they didn't have to make sure they paid their credit card off every month. They didn't have to cope with, that complexity. Another example, when my parents bought a house, that's the house I grew up in, they did not have to decide between an adjustable rate mortgage or a fixed rate mortgage. There were only fixed rate mortgages, and banks did not offer subprime mortgages. So again, it was much simpler. Now, adjustable rate mortgages, by the way, came around not until about 1982. Congress allowed adjustable rate mortgages. They were not introduced to benefit the consumers. It was an effort to try to save the savings and loans because interest rates had gone up a lot, and the S&Ls were holding a lot of long-term mortgages at low interest rates and trying to pay high interest rates to their depositors. Unfortunately, the S&Ls, many of them failed anyhow, and 30 years later, when we had the financial crisis, it was indeed the adjustable rate mortgages and the subprime mortgages that failed at a much, much higher rate. If you look at this, you see prime fixed rate mortgages, the delinquencies went up, but hit about 5%, while subprime adjustable mortgages were at 40%. And a lot of people who got those adjustable rate mortgages, who got subprime mortgages, really perhaps did not fully understand what they were doing. And when my parents retired, they did not have to worry about whether they had been saving enough. They didn't have to worry about whether they would outlive their savings. They had traditional pensions. They were both high school teachers, and they got their Social Security checks, they got their pension checks. It was enough to live on. End of worry. Things have changed. Let's see, this goes back to 75. About a third of workers had traditional pensions. So many people didn't, but almost, there were no 401k plans. They came around, basically the law was changed in 78. And again, the intention of Congress was not to create a new type of pension. They were just dealing with some regulations about additional deferred compensation. And companies I'll talk a bit more about this, but companies after a few years realized that they could save a lot of money and reduce their risk significantly by offering defined contribution plans such as 401ks rather than traditional pensions. And as you can see, traditional pensions dropped from about 30% down to around 10% of workers, and almost no workers in the private sector are offered traditional pensions anymore. And again, I'll talk in a moment about the ways that introduces complexity into people's financial decision making. Now, I teach a course. In fact, I co-teach a course. When I leave, when this talk is over, I'll be heading downstairs to Anderson Auditorium, where my co-instructor, Rob Shea, there he is, will have started our lecture. We teach about 900 students every semester. This last January, we had 900 signed up and 276 on the wait list. So there is a lot of demand from the UC Berkeley students to learn financial literacy, which I find gratifying. Most of our students I teach at the business school, but 90% of our students are not from the business school. We enroll both grad students and undergrads. Currently, about 90% of the students who take the class are undergrads. We have a number of goals with this course. Probably the number one goal is to teach or recommend useful rules of thumb. I'll give a couple of examples. We emphasize a few of these, and kind of with the hope that if a student can't remember anything 3 years after he or she takes the course, the student will remember a few of the here are things you must do. We also teach general concepts that enable students to understand the advice we're giving and to analyze new situations because the world is constantly changing. We examine how personal finance regulations and institutions differ over time and across countries. Often, young students come into the class and they sort of think, well, this is it. This is like physics. These are the laws or the rules of personal finance. But in fact, it's not true. Society, as a group, we determine how different aspects of personal finance are regulated and run in our country. In the course, our big emphasis is on, well, here's how things are now, and here's how you can navigate that best, and here's how to think about things going forward. But we also want the students to understand that these are societal decisions. We also want them to understand, we talk about who benefits from the current regulations, and when we bring in relevant academic research. Now, let me give an example. So credit cards, a rule of thumb. The big rule of thumb with credit cards is pay your balance off in full every month. If you're not going to be able to pay your balance off, if you buy something, you won't be able to pay it off at the end of the month, don't buy it. Are there ever exceptions? Yeah, but they're exceptional. They are not the norm. What about general concepts? We talk a lot about compound interest and the importance of fees. A person might say, oh, it's just 17% or 22%, but it's only going to be for a month. Actually, all of these things add up, and if you're carrying a balance, you're ending up paying a lot in fees, and also your interest is compounding if you're not keeping up with it. We talk about how credit cards are handled differently in different countries. For example, credit card interchange fees or swipe fees, those are the fees that banks charge merchants when the customer uses a credit card. Those are capped at 0.3% in the European Union compared to between like 1% and 3% are in the US. Now that has a couple of effects. For one thing, the credit card perks end up being smaller in the European Union. But if you look at the research on both the interchange fees and the perks, there's evidence that the high interchange fees or swipe fees that we have in this country end up effectively transferring about $3.5 billion from households earning less than $75,000 a year to households earning more. And part of that is because merchants if they're giving the bank 2% or 3% of each purchase, they raise their prices. And customers who don't have credit cards, those with, who are paying cash or using debit cards, pay those higher prices. Similarly, the reward system tends to redistribute about $15 billion a year from less well-educated to better educated, and from poorer to richer credit card users. That's in part because more sophisticated people and more educated tend to make better use of the perk system. Often poorer and less educated people who haven't taken the financial literacy courses will get credit cards that have high annual fees, but they're not taking sufficient advantage of the perks associated with those cards to justify the high fees. Let's talk a little bit about what's probably the biggest shift in my lifetime in terms of personal finance and financial literacy in the US. And that is the shift from defined benefit or traditional pensions to defined contribution plans such as 401k, 403bs. This was, as I say, this was not something that was thought out and planned by Congress. It was almost an accident. There's one benefit, I've got that at the bottom too, for employees, which is that the defined contribution plans are very, very portable. That means if you go from one job to another, you take your you keep your defined contribution plan. There are a few options. You can roll it over into an IRA. You can sometimes bring it to your new employer's plan. But there were a lot of drawbacks for employees, and a lot of these drawbacks, this takes up, I'd say, we probably spend 40% of our class talking about defined contribution plans, emphasizing the need to sign up early, automate your savings, talking about how to invest, how ETFs work, how index funds work, a lot of stuff. And this is all around the switch to defined contribution plans. So employees with defined contribution plans like 401k, employees are responsible for making sure they save enough. Now, that's a pretty difficult calculation for the average person. Imagine, you're 22 and someone says, so how much do you have to save a month so that you'll be able to retire when you're 70 and live comfortably until you die? It's a very difficult, it's a very difficult thing to figure out, and you can't figure it out with any certainty. Asset allocation risk. There's the risk that you put too much in the stock market, too little in the stock market, and then investment choice. A lot of people end up picking stocks. We recommend very diversified portfolios, but if you are doing stock picking and you pick the wrong stocks, you could end up with very little savings, even though the market did well. And then there's market risk. And market risk, that's like for a whole cohort or a generation. The US market has so far recovered from all of its downturns and usually recovered within 10 years, although not always. But other large economies have not had that experience. In Japan, the market took a steep dive back around 1990 and is still recovering from that. Longevity risk, and this is a big one, which is you get to retirement and you're trying to figure out, well, how much can I spend? And it's a relatively easy calculation if you know when you're planning to die. but most of us don't. And so you've got this risk that you might outlive your spending. Another risk is, and I'll return to this, which is scam risk. Scams have been around for a long time, but they're much more pervasive now than you know, they were 50 years ago. And because people have control over their savings in a defined contribution savings plan, their principal is at risk. Uh, Unlike with, say, Social Security, you cannot pledge away your future Social Security payments. With a traditional pension, you can't give that money away. You get a check every month. You could get scammed out of that month's check, but you would still be getting checks in the future. And basically, overall, there's a big loss of simplicity. My father and mother, they were high school teachers, as I said. It was basically go to work 35 to 40 years, retire, the check will show up in the mail. Now, the winners with the new pensions were mostly the companies. Their costs are much lower. Estimates vary, but maybe a half, sometimes a third, sometimes a little bit more. But the cost is much lower to the companies, and perhaps more importantly, the risk is gone. Companies are no longer responsible for making sure that they are saving enough in the pension plan. They don't take the market risk. They don't take the asset allocation risk. All those risks have been transferred to employees. And the other winner is Wall Street, because there are many new sources of fees. There's a lot, financial advisors have expanded their services because people now are, they have their own, their defined contribution savings, and they want advice as to how to manage it. There are fees associated with the ETFs and the mutual funds, and actually with the stock trading. All right, we teach financial literacy. Let me tell you a little bit about the course. One thing we try to do is make it as interactive as we can. Now, it's not that easy to be interactive. Like today, we're going to fill up a classroom of 299 seats, and we'll fill it 3 times. It's a lot easier to be interactive in a seminar of 12 students, but I imagine, like the University of Tennessee, the University of California is a big state university, and I can't, we have no way to teach 900 students every semester in classes of, say, 12 to 15. So some of the things, I'll give you an example of one of the interactive exercises we do. I show students where they can go to the FINRA website and look up the fees for a mutual fund or an exchange-traded fund. And I show them specifically, I ask them to look up the fees for a number of funds. I'll show you a partial list in a moment. For a $10,000 investment, assume a 5% return and that the investment is being held for a year. Here's one example in one of the Invesco S&P 500 funds. Now, this leads to a very interesting discussion, because here's a list of 7 of the funds I have them look up. All of these are S&P 500 funds. They're either traditional mutual funds or exchange-traded funds. And as you can see, for a $10,000 investment with a 5% return held for 1 year, the fees vary from $602.15 a year for that first year to $2.05. The students look that up, and then I ask them, why would someone pay $602 for something they can buy for $2? I mean, we're all used to paying a little bit more for convenience. Maybe I go to the local grocery store sometimes and pay 20% more for something I could get at the big supermarket a couple miles away. But who would pay $600 for something they could have for $2? It leads to discussion. Students will, first they throw out things like, well, it probably earns higher returns. And then I remind them, because at this point they know what an S&P 500 index fund is. And all the funds earn approximately, like to a very close approximation, the same return every year before fees. So actually, the Invesco is earning less because it has higher fees. And people go around, they say, well, maybe it offers a lot of really excellent services, but it's hard to think of a service that would warrant $600 in fees on a $10,000 investment in a fund. And of course, where we end up at is a discussion about how people get talked into buying something. For example, someone comes in to see a financial advisor and says, oh, my brother-in-law, he was at dinner last week and he said I should be buying S&P 500 index funds. And the advisor says, oh, yeah, that'd be good for you. And there's one I really like. And it happens to be the one that pays him a very large commission. So again, one of the things we're doing in this course is emphasizing the importance of fees and paying attention to fees and doing comparison shopping and comparing apples to apples. All right, I do my research. It's almost all about the behavior of individual retail investors. Here are some of the titles of papers I've written, most of them written with my longtime research partner, Brad Barber. Are investors reluctant to realize losses? Part of my dissertation, I showed that people, in fact, hold on to their losing investments, sell their winners, and that on average, the stocks they sell do better than the ones they hang on to and do better than the ones they buy. Trading's hazardous to your wealth. Brad and I found that the most active investors had the lowest net returns on average. Boys will be boys. We did a study of how the trading of men and women differed and found that men traded a lot more actively and that reduced the return on their portfolio by more than women reduced the return on their portfolio. The out of sight, out of mind was about how people tend to ignore expenses. And there's a lot of evidence that with mutual funds, with almost every investment, people buy the thing they wish they'd bought last year, and they pay way too little attention to expenses. Last year's return on a mutual fund doesn't tell you much about this year's return, but last year's expenses are probably very close to this year's expenses. Plus, you know what this year's expenses are going to be. We wrote about attention and have a lot of evidence that retail investors, many of them simply buy the stocks that are in the news or otherwise catch their attention. The trades of retail investors do affect markets. And we did a study. Most of my studies have been based on data sets here in the US. But I did a couple of studies with data from Taiwan. And the reason was because we had very comprehensive data. We knew every trade made by every investor in Taiwan, institutional investors and retail investors. Taiwanese investors traded very, very actively at that time, probably 3 times as actively as US investors currently trade. And we found that the retail investors, the individual investors in Taiwan, were reducing their returns through active trading by about 2% of Taiwan's GDP, gross domestic product, or in percentage terms, in the range of about 3.5% a year. Now, about a third of that was commissions. And as everyone knows, commissions are down a lot in the US. And about a third was a transaction tax, which we don't have. But the rest, about a third to 40% of those losses were simply by buying the wrong stocks and timing the market improperly. And the winners were institutional investors. And actually, a lot of those winners were foreign institutional hedge funds. And then the last paper on this list I'm going to talk about in a moment, which is about Robinhood. And I talk about Robinhood in my class, and I do so simply because a lot of the students are already trading on Robinhood when they show up in the class. I'd say probably a quarter of them report that they have accounts, and all of them have friends who have accounts at Robinhood. All right, active trading. Yeah, I've been doing this research for a little over 30 years, and I can kind of sum up what I've found, which is that active trading reduces the returns of retail investors. Now, here's a question I ask my students. Which of these men democratize investing for all? Some of you may know that the motto of Robinhood is democratizing investing for all. And the two young men on the left are the founders of Robinhood, and the old guy on the right is Jack Bogle. I knew Jack not well, but we met several times at conferences. He's the founder of Vanguard, and he's the person who democratized investing for all. He made it easy and inexpensive to buy mutual funds and low-cost index funds. The other two guys, they've made it easy and inexpensive to actively trade. So I'd say they democratized active trading for all. Robinhood, and let's just talk briefly about a couple of studies that we've done. Robinhood makes it easy, almost makes it fun. We've done a couple of studies about Robinhood. When we started our first study, I opened up an account. I thought I should know more about that which we were studying. I was surprised. I transferred in money from my bank, and even before the transfer, I was going to take a couple days. I was able to trade immediately. I placed a small trade. Confetti rained down my phone, my iPhone. It was kind of like playing a game. Robinhood has a simple environment, limited information, and we think in our paper we talk about this, that by limiting the information that the users see, they make the process of trading seem less complex. It's easy to trade. It feels a bit like a game. Robinhood itself does not have a social media platform, but a lot of its users go to social media platforms where they discuss, the latest and greatest trades. Can you intelligently invest for retirement on Robinhood? Yes, you definitely can. You can go on Robinhood, you can buy an S&P 500 index fund and hold it for 30 years, buy an ETF. Will you? Probably not. It's not an environment that encourages long-term, well-diversified, low-fee investing. We took a look in the first paper we wrote at a specific thing. We looked at days, these were about 0.5% of the days, in which the number of users or clients at Robinhood that owned a particular stock jumped a lot. And we called these herding events. And then we calculated how well the community of Robinhood users, the people who were buying and selling this particular stock, how well they did over a period going back 10 days before the event to 20 days afterwards. And relative to the S&P 500, they lost money. In fact, in absolute terms, they lost money. Some of them undoubtedly made money. There would be big run-ups in the stock price on days that a lot of new people bought the stock. But what we found was that they were tending to, most of the buying took place at the end of that run-up. So people who bought early at the low price and sold when everyone else were buying, those people made money, but most of the users they arrived as the party was ending. Now, we did another study that I thought I would just talk about briefly. where my co-authors, there were 5 co-authors on this project, we opened up accounts at 5 different brokerage firms and we placed 85,000 trades. And we placed them where the same trade would be placed at 2 or more brokerage firms at exactly the same time. Within a fraction of a second, we randomized which was first and second. And then 30 minutes later, it would be sold. What we were interested in is how much it was costing people to trade at these brokerage firms. All of these, like, we did look at one account that had fees, but the 5 that we were comparing all had 0 commissions. And we were interested in whether they had similarly good prices. And they differed. Here, for example, is a comparison of Robinhood and TD Ameritrade. Well, if you buy a stock without any information at all and sell it 30 minutes later and do this thousands of times, you're probably going to lose money. And we did. But for about 13,000 trades, we lost considerably more money on Robinhood than Ameritrade, a little over $1,000 versus a little over $4,000. So even though both were charging no commissions, there were differences in the quality of the execution. All right, that's my dad when he got older. My dad was a smart guy. He was a history teacher. He had thought about being a stockbroker. He handled my parents' financial decisions all his life, but he got a little less smart towards the end, as many of us do. In 1991, he bought a long-term care insurance policy. In 2009, he and my mom were in Seattle, and he tripped on a curb and fell, and was never quite the same after that. He got quieter, just wasn't quite himself, but he continued to make decisions. And a couple years later, he canceled his long-term care policy. He could not get out of a chair by himself. He had a chair that tipped him up. So he canceled long-term care policy. I have no strong opinion as to whether buying it was a good idea, but quite clearly, canceling it was a bad idea. He spent the last 2 years of his life in a long-term care facility. And there it is, the letter from Transamerica insisting that he has to sign a bunch of things in order to cancel the policy. I asked my mother after my dad had died and I found this letter. I said, well, why did you cancel the policy? And she just said, well, that was Dad's decision. He always made our financial decisions. One thing I emphasize in the course is couples should talk about financial decisions together. It often happens that one person in a couple takes over the financial decision making. And at the beginning, when that happens, I've seen a study that shows when that happens, there's usually not that much difference in the 2 people's knowledge of their financial literacy. But 30, 40, 50 years later, there's a big gap. And if the financial decision maker either dies or becomes cognitively impaired, the other person's not prepared to deal with that. And this brings us back to financial scams. My dad's mistake is what you might call an unforced error. He did that to himself. The bigger problem today is financial scams. Scams are increasingly sophisticated. Scammers reach virtually everyone. And people with cognitive decline are at high risk. And by the time you're over 80, there's about a 60% chance that you have some degree of cognitive decline and maybe a 30% chance after 85 of actual dementia. So this is a problem that, again, back in the 1950s, My parents didn't get phone calls asking them, saying that this is the IRS, and if you don't send us, some uh, a gift card in the next 3 hours, the police are going to show up. I was actually walking down the street once, and a woman ran out of one of my neighbor's houses with her phone and said, "Can you help me? Somebody from the IRS is saying I have to pay this today, or the police will come." And I actually said to her, "Hang up the phone. It's a scam." But people do get scammed. I know a lot of people who've fallen for scams, and they're getting better and better. So a common scam that I know two people who've fallen for is the grandma scam. Someone calls up an older person, says, "Grandma." The grandma says, "Oh, Billy, is that you? Yeah, this is Billy. You don't sound like yourself. Oh, I had a car accident and, I need money. Don't tell mom and dad." Well, that's going to change because pretty soon Billy is going to sound like himself because it's getting easier and easier to clone someone's voice. Why is this? Let me talk a little bit about scams. We cover this in the class. The 4 Ps of scam are pretend. The person's pretending to be the IRS, your credit card company, someone you've done a transaction with. There's a problem. You didn't pay something, there was a charge. Maybe the problem is you just won something, but we need a little money to process your winnings. There's pressure. This has to be dealt with now. And there's a payment, and often through non-traditional means. Now, one of the things, and I mentioned this earlier, one of the problems is not only are scams getting increasingly sophisticated, but older people have access to their principal, to more and more of their money, which means every now and then someone gets scammed out of a lot of money, like their life savings. This is a problem. Financial literacy alone is not going to solve this problem. It'll help. If you are financially literate and you've taken a course, you may help your parents take measures to protect themselves. Once cognitive decline hits, you start forgetting what you once knew. So anyway, these are some of the things that we cover in the class that I think are important. I'm going to wrap up here. Again, our course, we end on this note that as individuals, we live in the personal finance environment in which we find ourselves, but collectively we determine that environment. So Rob and I encourage our students to think about this and to vote. They can choose what their political preferences are, but vote for the local, state, and federal candidates who support your values. And that's our course. Thank you.
Thank you, Terry. That was fascinating. We're going to let some questions populate in the chat, but while we do that, I did have a question as an educator and as UTC is trying to roll out and expand our personal finance course. You hit on a lot of different topics that you cover. So can you just maybe give us, one of the two main things that you have found most effective in terms of assessing students that have gone through your guys' courses in terms of what really seems to stick?
Well, I think that's the reason I emphasize rules of thumb.
Okay.
Because, over and over again, I say pay your credit card off at the end of the month when you get your real career job, not working in the dining room while you're in college. But when you're out of college and you get that real job, you sign up for that. You sign up for the retirement plan, probably a 401k. You automate the savings. You save as much as you can manage. And then as time goes on, you raise that savings. And you don't take, if the company says, well, the default savings is 1.5%, well, that's not enough. So don't take the default savings as a guideline. And if your employer makes a match, save enough to get that match, at least. So those are things we say over and over and over again. There are other areas when I talk, I don't spend a lot of time on things like life insurance, but I do talk about it. I tell students 90, unless you've got really a lot of money and complex estate planning, you buy term life insurance. Don't conflate your savings and your life insurance. So we talk about things like that. Um, we emphasize comparison shopping and around insurance too. I give an example of, so I've got 50 videos on personal finance topics that I made. They're all free. You can watch them on YouTube. You can watch them on Vimeo. One of them is about auto insurance. When my daughter was in grad school, I told her that I would pay her insurance till she graduated, but that I wanted her to watch my video on insurance and to go out and get 4 quotes. She went out and got 4 quotes. 2 of them were low and pretty close to each other. I know she ended up with Geico. There was another one that was pretty low, but one of them was 3 times as high as the others for the same coverage. The embarrassing thing was that was the insurance company I had. I was so
Teaching
embarrassed.
you.
And so I went and looked and I dropped the cost because of what she did. I ended up dropping the cost of both. I ended up reshopping both my homeowners and my auto insurance and saved over $1,000 a year.
Yeah, I
So,
actually just did that with our home insurance. So, yes, it is very wise advice to shop around. But I wanted to, this actually piggybacks off of something that you just said. Charlotte in the chat has asked, what resources do you recommend to educate oneself on financial literacy? And apparently you have online content.
oh yeah,
Okay.
yes. You can, if you go to my website, which, just Google my name, there's a link to it. Otherwise, it's called makingsmartfinancialdecisions.com. Yeah, and we're trying to create new content. So lately, like I talked about the 4 Ps, one of my colleagues in law school made a couple of videos on scams for me. He's going to make some videos on dealing with debt collectors. So I made maybe 50 videos, and now I'm going around campus and trying to get people with expertise in one area or another of financial literacy to make, 5 to 10 minute videos that will help people.
That's fantastic. The development of online content is, I think, going to be one of the more beneficial ways of reaching everyone, young students, students in college, but also once you graduate, there's still, in some ways, as we get older, more and more issues that we have to deal with. And so this is just fantastic that you're doing this and creating this content. We've linked to it in the chat. I see your YouTube channel. We still have time for one more question. If anybody has a pressing question for Dr. Odean, we'll give another few seconds to let some populate. Okay, here we go. Oh, we got Mr. Parker, Bill Parker has podcast recommendations and also to support where do we find information for financial literacy. So that's fantastic. I think there's lots of options out there. Again, we appreciate your time talking with us today, sharing your expertise and knowledge, but also developing this online content so we can be continual learners. Thanks to everyone. I'm glad that everyone was able to get in. We've recorded it, so we'll be pushing the video out. Any last minute comments? Okay, I think we're good. Thanks for spending an hour with us and look forward to seeing you again soon.
Thanks so much.
Bye.